Thanks, Tom. Hi, everyone. I'm Jeff Tjornehoj. Going to talk to you about the fixed income review. We'll kick it off with a look at the overall performance of the fixed income universe here. I don't have all of our classifications here, but to give you a good idea, we put in about the top 24 or so. Well, the news for this quarter was rather interesting, and I think it really kicked off rather late in the quarter when Larry Summers took his name out of contention for Federal Reserve possibility as the next chairman. That was, I think, treated very favorably by the bond market because they thought that he was rather hawkish. Not everybody agreed with him taking his name out. They felt that it was an indication that the Fed had become too politicized. However, that's what happened. About a week or so later, the FOMC broke from its meeting and said, oh, by the way, we're not planning on tapering our bond buying program anytime soon. And when we look at the GDP numbers so far this year, I guess I could see their point. GDP estimates are now at about 2 to 2.3% for 2013. This is down from earlier estimates by the Fed of 2.3 to 2.6%. They also backed off their 2014 growth from 3 to 3.5% annual growth to about 2.9 to 3.1, so almost half a point down. The good growth that we've seen so far this year came predominantly in the second quarter, where we saw about 2.5%. But job creation has been very slow. The ADP private sector numbers came in at 166,000 for September. Certainly, the government shutdown means that September BLS data will be delayed. And in fact, we may not have any good employment data from the BLS for October if we don't have all those BLS employees at work taking surveys. So we may have to rely on the ADP figures again in November, looking back at October data. The interesting thing about the ADP data is that we haven't had a 200,000 job growth month since December of last year. We need 150,000 just to keep up with population growth. When we're at 166,000, it's not going to get us any closer to the magic 6.5% unemployment rate that the Fed has indicated earlier via the Fed Evans rule that would be necessary in order to start scaling back its quantitative easing. So if the Fed watches employment, and they've essentially said as much, I would expect further bond buying because these employment numbers are not giving the Fed a very good reason, if they're watching employment, to discontinue that program. So they may be looking at other things, inflation and so forth. That's also been pretty well controlled lately. The first group we're going to take a look at is inflation-protected bond funds, as well as the general U.S. Treasury group. Both had very different performance figures for the quarter, even though they're both Treasury products. And let's take a look at what happened here. So this is what's going on with TIPS lately. As you can see, we started off the quarter with a very good trajectory. The Lipper TIPS index was up about 1.3% from the beginning of the third quarter through early August. At that point, we started to see a little sideways movement here. We started trending down. They ended up losing about 3% of their value heading into that interesting time where Larry Summers pulled his hat out of the ring and then accelerated about 2.5%. This left TIPS funds with a quarterly return of about 72 basis points. It was a nice September for TIPS funds. They recovered about 1.34%. That still left them in the dust for year-to-date performance. They're the worst performer out there. Actually, one of the worst. They're down over 6%. So tough time to be in TIPS products right now. I tend to have a negative view on TIPS anyway, and we'll cover that later on. As I said, well, let's talk a little bit about the yield curve. Looking at this, it's hard to tell what really happened. It almost looks as if there was only a slight bit of turbulence in the data for the quarter. I suppose when you're only looking at a couple of data points, everything always seems to be a little bit easier than that. However, when we go to the next slide, we'll see that all along the spectrum, that the yield curve was bouncing around kind of violently in some areas. It doesn't appear that bad in this sort of smooth data set here, but it was not an easy time to be in treasuries for this quarter. So consequently, we saw a lot of activity in the belly of the curve. You know, the 5-year was, I think, particularly volatile. Both the 10-year and 30 ended up higher on the quarter, and this affected longer duration products. So, for example, general U.S. Treasury funds, though they had a nice little recovery in September, it's hard to see from this data, but the yield curve did dip down in September, of course, after the Fed rejected any proposals for tapering. But general U.S. Treasury funds were down for the quarter about 62 basis points. That's not a terrible quarter for them considering how high their duration is. This leaves them year to date down about 5%. So not an easy time to be in treasuries. Certainly as the equity markets have rallied, it's been easy to forego any treasury in your diet. The next groups to take a look at is the corporate groups of high yield, BBB and A-rated bond funds. We'll kick things off with a look at how all of them did together via the Bank of America Merrill Lynch indexes. These are the total return indexes for the bonds that these funds would buy. As you can see, it was a very good time to be in high yield after kind of a slow start to the quarter around July 4th. They kind of kicked it into gear later on, had a pretty good quarter overall, up about 2.21% on the high yield fund side, so not nearly as good as the index, a little bit of slippage there. I have a feeling that portfolio managers were maybe putting the brakes on their portfolios a little bit, maybe cutting duration. When you looked at what happened in August, that seemed like a prudent thing to do since the market was starting to go sideways on them. So consequently, the funds underperformed the index quite strongly. They did have a pretty good September. They were up about 1%. And essentially, they tracked the equity market. So July was pretty good. They were up nearly 2%. Then they dropped back in August and then accelerated about 1% in September. So not surprising to see high yield go in that direction. BBB and AAA bond indexes also tended to outperform the fund equivalent a little bit. So, for example, BBB funds are up about 70 basis points for the quarter. That's better than I'm sorry, that's not quite as good as the index, which is up about 1%. Meanwhile, the AAA index, which we don't have a AAA corporate classification at Lipper, instead we go with the single A rated. The single A rated did outperform the AAA index, I guess not surprisingly. The AAA index was down slightly for the quarter. Single A rated funds, however, were up about 44 basis points on the quarter. Both the A-rated and BBB rated funds are negative for the year. They're both down about 2.25, almost 2.5. So still a tough time to be in corporates because of what's going on with the equity markets kind of pulling the wind from their sails. On a related note, and we don't have this covered here, but when it comes to loan funds, they've done fantastic this year as far as flows data goes. They've taken in just tens of billions of dollars from investors. They too had a pretty good September and a pretty good quarter overall. For the quarter, they're up about 1.23%, and this gives them a year-to-date return of 3.58%, and that's excellent considering how low their durations are. They're really taking away that interest rate risk from investors. They've been flocking to them, hand over fist so far this year. U.S. leveraged loan issuance, by the way, came in at about $204 billion for the quarter. It's now up about 59% year over year. The third quarter, though, is down from the record issuance in Q2. Definitely the refi market has slowed down quite a bit. Again, when we're looking at the activity in the bond market in July and August, it was easy to see why that happened. But loans continue to perform well. The funds themselves also have done very well. Next group to take a look at is emerging markets. Here we've highlighted the hard currency funds. I think the next slide kind of pertains to both hard currency and local. And here is the performance of the Bank of America Merrill Lynch Emerging Market Corporate Plus Total Return Index. We've kind of seen this movie before. The index started off doing very well at the start of the year. So this is a year-to-date slide right here to give you some flavor of how volatile things have been for emerging market debt investors. So start off the year very strong, go into that summer doldrum by end of June, end of second quarter. Of course, they had a terrible second quarter, but that was really the point where they started to take off. A little bit of softness, of course, in August and July, but we really started to accelerate again once the tapering concerns were taken off the table. Emerging markets really accelerated in September. As you can see here, that's a very steep trajectory before kind of leveling off and going a little sideways on us. Overall for the year, though, emerging market debt is still down. We're looking at the hard currency debt funds are down about 6.5%. They would be the worst out there. The local currency debt is the worst. They're down about 7.92%. The hard currency is a little better, down about 6.5%. Both flavors had a tough go of things this year. Both rebounded very strongly in September for September's best performance in the fixed income universe. The final group we're going to take a look at is the general and insured muni debt categories. High yield muni debt really took it on the chin in the third quarter, as those funds were down about 2.5% for the quarter. They've had a tough time of it this year as well. For the year, they are down about 6.25%. So things are not looking well. They have not looked good for munis lately. So here is their performance versus the 10-year Treasury. We're using the bond buyer general obligation index here. As you can see, it rode rather smoothly up on yield as there was a lot of retracement going on heading into September, and then of course summer's announcement, everything starts to fall their way. Munis had a very good September. On average, they were up about 2% on the long-term products. The high-yield muni was up about 2.4%. Now, a lot of the performance of high yield can be traced to Puerto Rico. It's had a tough go of things lately, and some are wondering how much risk there is in high-yield muni debt, and even in some single-state and national muni debt that is investment-grade rated. There may have some portion in Puerto Rico paper. So this is what happened to Puerto Rico general obligation BBB-. This is the lowest-rated investment-grade Puerto Rico debt. Again, general obligation. June yield curve here in red. It was at about 600 basis points. This is not spread. This is just yield. Come the end of September, it had jumped about 200 basis points. So in many ways, Puerto Rico debt is effectively shut out of the bond markets right now. There's a good comparison to be made between Puerto Rico and Detroit, and there's some bad comparisons as well. A couple things to consider is Puerto Rico is an island nation of about 3.7 million people. They have about $87 billion in debt. By comparison, Detroit, a little smaller, their debt a little smaller as well. On a per capita basis, Puerto Rico has about $23,000 in debt. So per person, man, woman, and child, $23,000. Detroit, that figure is about $25,000. So Detroit in slightly worse off than Puerto Rico citizens. However, Detroit's debt is all due to pensions and retirees. Politically, they tend not to be as well. Actually, politically fairly vociferous. They can get some attention. However, they don't have that much influence often in the markets. We look at Puerto Rico's debt. It's all to bondholders. And as we've looked at what happened with Argentina, bondholders don't go away very easily. So it's possible that Puerto Rico's situation is more serious than what Detroit is dealing with. Detroit obviously filed for bankruptcy. It's not clear, and in fact, most people say it's not possible for an entity like Puerto Rico, being a territory, to file for bankruptcy. There is no Chapter 9 for them. They're not considered a municipality. So we'll see how this goes. Puerto Rico is definitely a place to keep your eye on. Some managers saying this is a great buying opportunity. Look, you can buy this debt at an 8% yield, and likely no one's going to let Puerto Rico fail. I don't know. We'll have to see what comes of it. Elsewhere, the other news for muni markets to give us a little bit more confidence going forward is Moody's raised the outlook on the United States as a whole. I guess they overlooked Puerto Rico. And they raised their outlook to stable. It had been sitting at negative for the past 5 years. So there's a little shot in the arm for municipal debt investors. As well, if you're looking at high yield muni in general, and maybe there are some portfolios that hold more Puerto Rico than others, evaluate as necessary. But the tax equivalent yield on high yield muni is about 6.94%. That's better than the 6.35% that's commonly available on high yield corporates. So pick and choose your asset class right there. Just know that defaults in the muni space, high yield muni to be exact, is still far lower than it is for high yield corporates. I'm still rather bullish on munis. So we'll wrap things up here with a view of my concerns. Certainly, as Tom highlighted, it's all politics all the time right now. Whatever comes out of Congress, the markets are listening to with bated breath, looking for signs that some resolution will come with this. The markets hate uncertainty. We've seen equities slide. It hasn't done anything favorable for bonds, really, because people have said, well, if the issue is whether the U.S. Treasury has enough money to pay and avoid a default, why would we jump into Treasuries then? So it's not a good time for anybody. Soon the conversation will turn towards debt ceiling. Maybe that will be part of some grand compromise. They talk about a November surprise. I think we might be looking at an October surprise in this case. A couple things to consider on a slightly longer-term outlook. Without the tapering, the market's view of higher interest rates was removed in effect. So all the concern that the 10-year was going to be sitting at 3.5% by the end of the year, or 4%, as some banks have said, I think has been sharply curtailed. There's really no real fear that rates will run that much higher, knowing that the Treasury seems prepared to stay in at least through this year and likely well into 2014. So in other words, the theme for now is low for longer. Low rates continuing longer than people expected. I still believe that loans look attractive. Emerging market debt and high yield also look attractive to me. Probably should have thrown in something about munis as well on a tax equivalent yield basis. That still looks awfully enticing. I don't believe that tips have much going for them these days. Inflation looks very well under control. So there's that going for us as well, especially with the unemployment rate staying stubbornly high. It's going to keep the Fed in the market, and eventually we may get some bout of inflation to deal with, but that certainly looks a long way off. So that will conclude the fixed income review.